Hello and welcome to a very special broadcast here on News 9 Live. I am Krishna Kumar, and on this show we're telling you all about how the stock markets and all your investments are likely to perform in the upcoming brand new year 2025. And for that, we have some very special guests joining us. So we have Mr. Andrew Holland, CEO of Avendus Capital. We also have Mr. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company. Thank you both of you gentlemen for joining us on this very special broadcast. I'm going to begin with you, Andrew. Talk to us. The stock markets have seen some pain towards the end of the year 2024. In the new year 2025, the question now is not how well can the markets perform, but how much pain is there still left?
Yeah, it's a good question. I think there's a couple of things from a global perspective. I mean, obviously, we still have to see President-elect Trump take office, and the volatility around what he's going to do, I think, remains. I think for India, I think that the thing that's been holding the market back has been all the downgrades that we've seen recently. Across all sectors virtually, and with GDP growth slowing, I know the RBI says 6.8%, but we think it's probably near to 6%. So potentially you've got some more downgrades coming in the first part of the year as well. So that will keep markets, I think, pretty much range bound depending on what happens when Trump takes administration over the administration in the US. I think the second point is also, well, with FIIs or FPIs having moved away for the back end of the year, the demand side of it still remains strong from the retail sector in terms of buying into mutual funds. But of course, the supply is really catching up, whether it's through IPOs, QIPs, block trades, and at these kind of valuations, you can't blame companies or promoters for taking some money off the table or raising money for future expansion. So I think that's what's going to keep our markets pretty much range bound. But I go into 2025 feeling a little cautious. I don't think it's going to be business as usual. I know we've gone through a lot this year, so I'm not saying there's complacency, because there has been a lot of negatives in 2024 which markets have coped with. But I don't think it's going to be business as usual with the Trump administration.
It won't be business as usual in the markets. Nilesh, talk to us. Look at those returns from the stock markets, from the Nifty, far below the returns, say, gold and silver has given in the recent past. So talk to us. Let me begin by asking you, which asset class do you think will outperform in the new year 2025? Will it be markets, gold, silver? Which one?
So this is the year where returns will moderate and converge. Last 5 years, equities delivered not only broad-based return, but also exceptionally high return. The gap between debt and equity, real estate and equity, was very, very high. Gold did outperform fixed income and came closer to equity, especially large cap. But 2025 is likely to be a year where debt, equity, gold, and real estate returns will converge, and they will be in a narrow range. And hence, it will be important for investors to invest with longer term time horizon, not with 2025 in mind.
Right. Andrew, talk to us. Nilesh there talking about the fact that all the returns are going to converge. There's not going to be, clear outperformance amongst the asset classes. But, there's lots of talk about gold, how gold had a tremendous run in the 2024. The question here is that if you're going to be cautious on the stock markets, and even those investing in stock markets should not invest keeping in mind that 1 year time horizon, definitely not, then how do you think gold will perform in this context?
I think gold will again be pretty volatile in terms of the first quarter. I think everything is a lot about when President-elect Trump gets in and what his policies will be. I can spin in terms of the tariff increases. I could then say, okay, it's going to be lower than expected, which would be good for emerging markets, particularly China. So I think there's a lot of moving parts here. To just say you should be in one asset class right at this point of time going into 2025. I guess the strategy that we would have is that Holding a bit of cash as a strategy until you can see a clearer picture of what's going to emanate from the policies, I think is not a bad is not a bad kind of strategy to have. So you'll get 6-7% just putting it into fixed income in terms of gross return. So I think just in the shorter term, I think it's worth just having a kind of a cautious strategy and not putting too much money to work in either of these asset classes, because I think it's going to be difficult to kind of gauge which one will be the best. Again, if you ask me now, I'd be kind of more cautious on, say, the commodity basket. But if the China tariffs are lower than 50%, then obviously that could be an asset class which we could move very quickly. So I just think just waiting for 1 month is not a bad strategy.
Waiting for a month is not a bad strategy. Nilesh, there are rate cuts that are seemingly on the horizon. The big question is, if that being the case, can gold continue its tremendous run in 2025? Gold, is non-interest bearing, so rate cut makes them more attractive.
So gold returns have post-2020 COVID crisis have been exceptionally good. To some extent, gold prices change orbit whenever US interest rate comes down decisively. Now, with Fed indicating only 50 basis point rate cut going forward in the next year, gold prices will start stabilizing. But gold is also supported by central bank buying. They are like Indian housewives. They continue to buy gold and don't sell. So my feeling is that gold will still deliver better return, positive return, but not as high as, let's say, last 5 years average.
Okay, Andrew, we'll let that be as far as gold is concerned. Quickly talk to us about silver. Lots of talk about silver, especially in India, crossing the 1 lakh rupee per kilogram mark. Any particular predictions you have for silver in the upcoming year? Should investors prefer silver over gold?
To be honest, I'm not a particular kind of expert on silver. From a personal viewpoint, I kind of like Bitcoin. I think that's probably got a lot more to run in the future. So that's, if I had a kind of a really alternative asset class, then I'd probably look more at the Bitcoin than I would at silver. But I'm not an expert on silver, to be honest.
Okay. Clearly, as you go, the kind of returns that Bitcoin had given there 2024, there is enough and more people betting on it. But Nilesh, let me get this back to you and get this back to the stock markets you're talking about. Tell us, it might not be a breakout year for the stock markets, but as far as the Nifty is concerned, can it reach the 30,000 mark? And as Sensex is concerned, can it touch that 1 lakh mark?
So as I say, Mangalwar ko Sensex will cross 1 lakh. But just don't ask me the date. Frankly speaking, it's difficult to predict future. And don't invest with 1 year horizon in equity for sure. Don't invest in equity with last 5 years return as expectation. The actual returns are likely to be far lower. Don't invest in small and mid cap because 5 years they have delivered 25% plus return. The returns are likely to come down significantly. So equity market, be a long-term investor with moderate return expectation, you will do well.
Fair enough. Moderate return expectations. You seem to be concurring with each other, Andrew. But Andrew, again, if I were to ask you, what are your targets? Considering that you have to temper your expectations of the stock markets, where do you see the Sensex and the Nifty in the new year 2025?
So when we came into this year, we said that we thought the market might rise in line with earnings growth, and earnings growth we predicted around that time was about 15%. With all the downgrades, it's looking like 10%, or probably a little lower actually. So that's where the market is, and if I kind of fast forward to 25, 26. I'm expecting earnings growth of anywhere between 5 to 10%, and that's the kind of level I would think the Nifty would rise in. So I think it's not really the indices that you should be looking at. It's really what may be the themes or sectors which will continue to do well despite any kind of slowdown. But the big worry is this: is that I talked about Trump getting in terms of the administration, but not all things are going to turn out the way the market's expecting. And if there's anything that goes awry in that America first, love America kind of investment theme at the moment, and particularly with the kind of Magnificent Seven so-called, any kind of earnings downgrades there, the valuations in the US are very, very high, and that could have a cascading effect on all markets, including ours. So whilst relatively we say we're okay against, when President Trump comes in compared to other countries, that's all okay. But if you have a major sell-off because of any problems in the US in terms of earnings, that will affect globally as well. So I'm just, going to say I'm a little bit cautious going in. If everything turns out as not, as kind of business as usual against my expectation, then 5 to 10% is what I would expect to see in terms of the Nifty kind of increase. But I would suspect you're going to get better opportunities below the index or in certain sectors.
All right, let's then get to it. Then this entire show is all about telling viewers, the retail investors watching us, what can they expect, and hence experts on this panel need to start giving some bold predictions. Nilesh, let me begin with you. Talk to us. If I were to ask you 3 bold predictions for markets and investments in the year 2025, what would they be?
So one, President Trump administration realizes that India creates win-win situation for America. We do benefit from American IT and KPO outsourcing, but we reduce their cost and increase efficiency. We do benefit by their generic medicine order, but we reduce their healthcare cost. Realizing how India's partnership has benefited American consumers and American economy, they extend this across many other verticals, many other sectors. Second, India takes out-of-box thinking in supporting growth. Today, land reforms, labor reforms, farm reforms, judicial reforms are not on the horizon. But our voters convince political leadership that they are happy to go along with the reforms. And by unleashing the next generation reforms across land, labor, judicial and farm, we are able to change orbit of India's growth rate from mid-single digit to high single digit. Third, the world continues to score self-goal, and hence global investors continue to invest in India. They realize that Indian markets trade at a premium valuation because their growth and governance is far better. These 3 are more prayers and wish list rather than bold prediction.
Okay. Again, reticent largely, but again, I'm going to ask you as well, Andrew. If I were to, put it at you, 3 bold predictions that you would give for the upcoming year, 2025.
So I think in terms of globally, I think what we're seeing or what everyone's predicting will happen for the US doesn't happen at all, and it's really more detrimental to growth than the market's expecting, and I don't think that would bode well. So that would bring all markets down. That would be the first thing. The second thing is the dollar continues to strengthen, which would be very bad for emerging markets and commodity prices as well. So that would be something which we'll probably see in the near term. And finally, for India, this is a hope rather than a prediction, because the budgets are always kind of difficult to predict. But hopefully, no more tax increases. I think we're all kind of and everyone is commenting on how much taxes everyone's paying. So I think if we get some relief, if in terms of no taxes being raised, I think that would be good. And of course, we saw capital gains tax raised last time around, and the gap between equities and bond markets, kind of taxation is very, very wide. So that would be something I would hope we wouldn't see any kind of further moves.
Andrew, let me begin by asking you something more specific. Let's talk about the markets. In terms of stocks, if I were to ask you, how do you think the stocks are going to perform? Let's just put it in terms of large cap, mid cap, and small cap. Lots of doubts surrounding mid cap and small cap. But tell us, how do you think the year 2025 is going to be for large cap, mid cap, and small cap stocks?
Well, as I said previously, if you take the Nifty as being the large cap kind of index, then anywhere between 5 to 10% increase along in line with earnings, if that was to happen. For mid cap and small cap, I think because the economy is slowing, I think it's an area that we have to kind of be a little bit more cautious on in terms of asset allocation there. I would be a little bit more skewed towards large cap, only for the protection side of it, because if earnings are going to continue to be downgraded, then I think it's going to be the small and mid caps which feel the brunt of this in the shorter term. And of course, when markets fall, it's all, the illiquidity of some of these stocks, exaggerate, the kind of falls as well. So I think one of the things that does worry me, if there is a more sustained fall, is a lot of these kind of sectoral type of funds which have been kind of raised over the last year or so. That's where there could be a little bit more pain. Say, for example, if you bought a defence kind of mutual fund and that was a sector which was out of favour, then it could be very painful for those types of sectoral kind of bets that people have made. So I think being a little bit more kind of quick in terms of taking action of where you want to kind of allocate within sectors is probably going to be one of the things which will play out better for you in the year ahead.
Okay. The size of the stocks tell us a lot of things. Nilesh, talk to us, large cap, mid cap, or small cap. Where do you think investors should be focusing on?
So we believe last 5 years, large cap delivered about 16% return and small and mid cap delivered about 27% return. That gap is likely to narrow down significantly, and overall returns will also come down significantly. The risk return is better in large cap over small and mid cap. This risk return is better in reasonably valued stocks rather than momentum stocks or expensive stocks. And risk reward ratio is better in those stocks which have higher floating stock and more market determined prices compared to stocks which are not compared to stocks which have controlled floating stock.
Andrew, I have to ask you, do you also concur with that? The returns between large and mid cap, small cap stocks, is going to significantly, that gap is going to significantly narrow in the new year 2025?
Yeah, I do, because I think the earnings downgrades will probably, be a little bit more severe for small and mid caps if that's going to take place. So, I think Nilesh is bang on. I think you've had a great returns in small and mid caps, and that if you're looking for lower returns overall for Nifty, then the gap should close because there's no catalyst for those stocks or those some of those sectors either, given the valuations within some of these sectors. So it's going to be a tough year, I think. So that's why I'm saying I think maybe playing out some of the themes which you think will do well, not just in the next 1 year, but over a longer term period, I think is probably where you should be kind of placing your kind of monies at this point of time, rather than saying I need to be in small cap as a kind of basket. I think individual stocks will probably play out better.
Okay. You're talking about themes, then let's talk about themes then. Andrew, talk to us, what are the sectors and themes to watch out for in 2025, both in terms of where investors should be putting their money in and also in terms of taking their money out. What has performed so far so well might not be doing so well in 2025, and what hasn't done so far so well, that could be doing well in 2025. Sectors and themes I'm talking about, Andrew.
So on the kind of, in terms of the more negative side, should I say, in terms of my views, then I think the paint industry, is facing a lot of headwinds, just from material input prices, but also from price competition. There's a big new player out there. And I think it's going to take some time for this to really play through. I know there's talk of consolidation within the industry, but even that means that there's going to be more competition. So I think paints is an industry which still commands high valuations, but I think the outlook remains quite poor. I think commodities in the very short term could be under pressure if the dollar continues to show its strength as it seems to be doing at the moment. And of course, we still have to wait to see if China can stimulate the economy or they're going to do further packages. So those are the two I would be out, to my mind, are out of favor. I think autos again is a very competitive market from not just the traditional kind of four-wheelers and two-wheelers, but with EV coming in. I think it's going to be a more difficult year for the auto companies going forward. In terms of things that I still like the hospitality industry. I think people are going to want more and more experiences, and that leads it also to premiumization within the beverage industry. I think that will continue to do well. So these are kind of longer term, themes which will continue to play. I still like the electronic manufacturing sector. I think that's a theme that's going to play for many years, and is beneficiary of both domestic demand and of course depending on what President Trump does and listening to what Nilesh said about more favorable status for India with him, then electronic manufacturing globally in terms of exports, particularly to the US, could be very big over the next 3 to 5 years. So I expect very strong growth from that. And of course, the new platform stocks, I think, having everyone worried initially, would they cash flow positive? Would they make profits? I think all of that's behind them now, and you can see that they're eating into market share. They're moving into different parts of the industry, like ticketing, and so again it goes back to experiences, and I think that's that will continue to gather pace. So I like those companies as well.
Nilesh, talk to us. Tell us, what are the sectors and themes that, according to you, are the ones to watch out for as far as investors watching this broadcast is concerned? Where should they put their money in, and where should they take their money out from?
So essentially, it is always the stock selection within the sector which makes all the difference. And we are likely to see more and more sector and stock rotation in the coming year. But at this point of time, we believe private banks and financial services, IT, pharma, and consumer staple, especially focused on rural India, should do well. Some of the overvalued stocks, expensive stocks, including recent IPOs, some of the infrastructure and capital goods company trading at exorbitant valuation, and some of the defense and railway kind of low floating stock PSUs, they are unlikely to outperform the market in the coming year.
All right. We also have Feroz Aziz, Deputy CEO of Anand Rathi Wealth, now joining us on this broadcast. Thank you, Feroz, for taking time out to be with us. Quickly, we're all talking about how investors need to really temper their expectations from the year 2025 because it won't be business as usual. That's the word coming in from Andrew Holland and in fact Nilesh Shah as well. If I were to ask you, for all the retail investors watching this broadcast, talk to us. How do you think the year 2025 is going to be?
Good morning. I think 2025, like Nilesh sir and Mr. Holland also have already indicated that you have to have a fair expectation. Whenever you have abnormal rises or abnormal falls, we have to all remember that mean and median, which is what a person's expectation could revolve around. if you look at Nifty's mean returns over long periods of time by which I generally define this century, is about 14.5%, which is the mean return. And I don't even think a person should anytime expect a mean return as well. A median return is nothing but the return which you can expect with a 50% probability on a 1 year holding period. So that's 11%. So most people actually portray mean returns, which I think is a little exaggeration. So median returns is what you should expect out of Nifty on a year-on-year basis with a 50% probability, not 90% probability. Now coming to more specific of 2025, I personally believe that we have some degree of correction. If you're not already at the peaks, which is 52-week highs were almost about 26,200 on Nifty. And the earnings estimates for this year are at about 1160 still for Nifty in terms of rupee terms. And the first 2 quarters have already delivered a reasonable growth. I don't think the narrative is that, but if you look at the total growth for the first 2 quarters which have gone by and the results have come, is about 6.9%. 483 rupees is in the bag with respect to the earnings. So coming back to your pointed question, I would say plus or minus 2% than median return on Nifty. And Nilesh sir, kind of fund managers, CIOs, MDs of asset management companies can deliver you 2, 3, 4% over and above Nifty, and that should be the objective of creating a mutual fund portfolio.
Okay. Quickly also tell us, if I were to ask you for 3 bold predictions for the year 2025.
Okay, that's a very pointed question. I personally think any prediction or any prediction is a little forecast, which is statistical, can be called predictions, can be called a forecast. So if you ask me to forecast something on the basis of data, I've tested several hypotheses of what can be done in 2025 and what has significance levels of greater than 90%. But anything which I say, if it's not actionable, generally people give forecasts on sectors and you can't act on it as much. So I would say a forecast on mid cap and small cap is not going to be as bad because people are missing the most important point. FII in 2024 was hugely net outflow, but there are 168 stocks in 250 NSE small cap index where FIIs at the same time have increased their shareholding. There are 38 stocks in Nifty small cap 250 where they've doubled the number of shareholders. So whatever the outflows we have seen in 2024 from FIIs cannot be categorized as an exit, because when the rebalancing is something which we all propagate. So coming back to your pointed question, I would say that there will be buoyancy in the small cap and mid cap index in spite of valuations being stretched. There is pockets of huge value there, point one. Point two, don't quit your small cap. If you're already at 20%, 25% of small cap and mid cap being 40%, in total, you're nothing to worry about if you're able to weather the storm for 4-5 years. That's point one. Point two, I personally think there are some smart beta strategies which asset management companies have launched. Like Nilesh sir said, there are some low free float. So P's have a strong correlation to low free float. So I would say some low free float sectors which are garnering a lot of money might see some alphas over Nifty. And that one such index which I see is the newly launched Nifty Capital Market Index. The stocks, about 15 of them, those relatively have a larger demand than supply. Since you're asking me 1 year, and demand and supply has a large role to play in 1 year performances. So I'll stick to 2 predictions rather than 3.
Okay. Stick to 2 predictions. Andrew, I have to ask you this. The talk of the FIIs pulling money out of the Indian markets. Are Indian markets too expensive where they are right now? Where do you stand in the matter, and what do you think will happen with the foreign fund flows in the year 2025?
So first of all, I don't think there's any rush for foreign investors to jump back into India. We got the earnings results coming in January, which, as I said, I think will be disappointing and more downgrades. We got President Trump-elect, coming in at the end of January, and the policies as he's going to bring. And of course, if everything's looking good for the US, which everyone says it is, there's no need to rush and do anything in emerging markets. Now, what could change those flows would be maybe less tariffs or lower tariffs to say China. Instead of that 50%, it's 30%, which would mean that flows would come into China in particular in emerging markets. I mean, we'd get some obviously because of our weightage, but given our valuations, I'm just not seeing at this moment the catalyst for the markets to move higher from a kind of trading range of maybe 23 to 25,000 on Nifty, because earnings isn't going to be the supportive factor. So if anything, it can only be global markets which help, or something that changes in terms of the prospects for emerging markets within a Trump regime, which we have to wait and see. So I'm a little skeptical that FIIs are going to rush to the Indian markets, particularly given the stronger dollar at the moment. You lose money on depreciation of the rupee as well. So there's no rush to do anything. But I think the biggest factor is, to my mind, if anything goes wrong in the US, there's more noise, or there's more narrative around whether it's coming into bubble territory. I'm not saying it is, but if that was the case, then as we saw in the early 2000s, it can have quite a large impact across global markets.
All right. Feroz, again, I've asked this to Andrew and to Nilesh as well. If I were to ask you, what is your target for the Sensex and the Nifty? Can the Nifty touch 30K, and can Sensex get to 1 lakh in the year 2025?
Hey, now this is something which is not forecastable.
We know that, but if we were to take a shot at it, where do you think the Sensex and Nifty are going to be in the year 2025? How high do you think they will be?
See, if I look at my median return expectations, 13 to 14%, I would say we will fall short of 30,000 unless there's something which emerges. So I would say about 27, 28, because we are not at the peaks currently, which is 26, 200. Now, if you look at the short-term barometers, I checked. When we look at derivative treasuries, we look at 4 different barometers, which are very crucial. I personally think if you look at the long-short data, it has the strongest correlation with respect to 1-2 months performance of Nifty, which is not easy to predict. There are 4 barometers which we check, and we have tried to check their correlations. I personally think only one of them is in the red. 3 of them are okay, and we have tested them reasonably deeply, statistically. So I would say I would not be too worried about a catastrophic situation at all. The kind of lead indicators which market crashes beyond 20% have given, those lead indicators don't seem to be the case today. So I'd be okay, because only 6.7% of the domestic flows are into equity, that to financial assets. So there's a long way to go in terms of financialization, and that will keep the markets buoyant. The 500 company in India, in NSE 500, has a free float of only about $50 billion. $500 billion. So I personally think there's not enough free float in India to be able to absorb the country, 140 crore countries' savings, who are good at saving.
Okay, quickly, if I were to ask you, any particular sectors, according to you, where investors should be putting their money in, and any particular sectors where you think investors should be taking their money out of?
So I personally think IT as a sector will go through a paradigm shift over the next 3 years, not about 3 months. And only if a person has the capability to spend time to decide an exit is a qualified investor to invest in a sector fund. It's not about the entry alone. It's more about the exit. Most people buy high and sell low. If you're able to control that recency bias, which is a huge human emotion, is when you're a sector fund investor, a good sector fund investor, for the temperament it deserves.
Andrew, let me begin with you. This is a question on behalf of all the mutual fund investors out there. We're talking about stocks so far, but talk to us from the point of view of mutual fund investors. What would be your advice for those investing in mutual funds, and how they should go about it in the new year 2025?
I'm sure Nilesh would be the better person.
I will ask him that, but just to ask you an overview, any particular kind of funds they should be investing in?
See, I've always believed that the investors should be doing SIPs, and I think they'd be doing that brilliantly anyway. So yes, you're going to buy at the top, buy at the middle, buy at the bottom, but it's just the way to go. So I think in our themes we talked about maybe being a little bit more kind of skewed towards large cap going into 2025, and that's probably what I would do. I'd probably not be so keen on sector type of mutual funds, because if markets do fall, it becomes a very crowded space for investors, and therefore if that sector is out of favor, it could cause a little bit more pain than usual. So I would continue to do SIPs. I would continue to look at large caps in 2025.
Right, let's ask the man then who knows all about it. Nilesh, talk to us. Your advice for mutual fund investors. Should they, what kind of funds? There's all kinds of funds out there. There's a flexi cap fund. There is balanced fund. Talk to us. What kind of funds should mutual fund investors go for in the new year 2025?
You have to first look at yourself and understand your risk profile. If you bought during COVID crisis, then you are aggressive investor and you can look to invest in thematic funds, sectoral fund, mid cap and small cap fund. If you redeemed money during COVID crisis because of fear, then you are extremely conservative investor. And then you should be looking at balance advantage fund, large cap fund, balanced fund. If you continued your SIP during COVID, you are average risk taker, a large and mid cap fund, a little bit of small and mid cap fund will be appropriate for you. There's no doubt in my mind that over a period of time, small and mid cap will outperform large cap, but the volatility will be higher. You should have courage to sit in the roller coaster throughout the journey. Then only you will be able to enjoy the roller coaster ride. If you think you will jump out in the middle of a roller coaster ride, then certainly you will break your hands and legs, you will get injured, and you will not enjoy the ride.
Roller coaster ride. Feroz, talk to us. What kind of a roller coaster should mutual fund investors go for in the year 2025?
Kumar Saab, mere hisab se, okay, if you look at Nilesh sir when he was saying, he's saying exactly what I would like to say. But let me break down an investor into 2-3 categories. Like the barometer which Nilesh sir said for somebody to actually look at their risk appetite and understand it better, because risk in India or in wealth management industry, unlike treasuries, is spoken in English. High, low, medium. I think there are 3-4 measures of risk. I think one very good layman understandable measure which Nilesh sir gave, which I think is something which all of us should take note of. Now coming back to what should an investor do? There are two kinds of investor. One are prospective investors, the other are actual investors with varied levels of investing experience. So if I try and break this into 3 parts, one is a new investor who's thinking 2025 is the best year to start. For those kind of investors, I think you can start with multi-cap if you have money for only one scheme. Now, a new investor who has money to do an SIP for 3 schemes, he should then definitely go for a large cap scheme, one of them, or a flexi cap scheme, which are largely heavy on large cap. So, new investor with more money, flexi cap plus a large cap plus one small cap. That's what I would recommend to a new investor who's beginning. If he is beginning with little money, with 1,000 rupees to do a SIP, then you can go into a multi-cap category. That's from a new investor standpoint. Then there are some investors who have been investing for long periods of time. Let's assume that we break that down into 2 parts: less than 5 years of mutual fund investing experience and greater than 5 years. If you are less than 5 years, then surely stick to schemes which are more conventional, which are broad classification on the basis of size, which is large cap, mid cap, small cap, flexi cap, multi cap. These are all classifications on the basis of size of the company. Stick to the top 4-5 asset management companies who have a larger bandwidth with respect to analysts and fund managers. That's what I would do. If you have more than 5 years of investing experience, then you have graduated, your undergrad is over, now you are in post-graduation. So if you are there, then you can look at some smart beta strategy or look at asset management companies who are offering some degree of thematic funds where there is some degree of value. As long as you stick to large AMCs, there's a lot of value. We did a study which listed down the top 3 asset management companies, all NFOs over the last 5 years, to find out if one were to invest in all NFOs, what would be the alpha over Nifty, and it's actually good. So till some time back, I used to be worried about the extent of NFOs. After I saw that MIS, my nerves calmed. So this is what I would say to 3 set of different investors.
All right. Andrew, if I have to ask you this question, will 2025 be the year investors look for value instead of chasing growth?
I'm not sure that investors will look at it like, because value, you'd have to see the markets could have taken quite a big hit before you start looking for value. So I'm not sure. I mean, there will be pockets of value somewhere, but it's all relative given the valuations of our market. So I'm not saying that value is not there. I'd probably look at these companies which are might be looking to divest some of their businesses, either through IPO or delist or from other listings, going forward. But otherwise, I don't think it's a strategy that I would really be looking to play. I think the momentum's either going to be very much to the upside or to the downside. I don't think there's value, to my mind, is a strategy that I'd want to play.
Nilesh, if I were to ask you the same question, will 2025 be the year where investors are looking for value, and they should ideally be looking for value instead of chasing for growth?
This value and growth are in some sense interrelated. Your value will not be unlocked unless until there is some growth potential. And growth at any price is not appropriate, because then you really need longer term time horizon. So undoubtedly people do categorize stocks in value, growth, and growth at reasonable price. My feeling is that you should be looking at growth at reasonable price. You don't need a debt company which is not growing, and you don't want to pay any price for the growth. Growth at reasonable price will be far more appropriate. It will be Harfan strategy.
Feroz, tell us, value versus growth, where do you lie?
See, I personally think, like Nilesh sir said again, value doesn't become growth unless there is momentum. So what happens is, I'll just tell you one study which clearly shows Indian investors bypass performance. So a value also, like in 2021, when we included 3 value funds suddenly, because there was so much value from a valuation standpoint on any barometer of valuation, they did very well. So we included about 3 sudden funds. Suddenly we included 3 funds in our model portfolio which are value. It took about 7, 8, 9 months for market to realize that, and that's when the momentum came. It's like a Chetak scooter. Unless past performance is good, people don't invest. My dad used to punch that scooter 10 times to start it. So a value has become growth currently, and it's got submerged, it's got smushed completely. So I think it's not so categorically specific in 2024, 2025, especially this calendar year. I would not be able to categorize between value and growth so easily. That was a sector classification more meaningful in 2022. Now it's both interjected because 83% of small cap funds, surprisingly, Mr. Kumar, you would realize that have chosen Nifty as their tier 2 benchmark. So when somebody was telling me value growth at reasonable price, I asked him to define his benchmark and tell me which are the 300 stocks which are his universe. And he struggled to do that. So the point I'm trying to make is there are 155 fund managers who need to actually put down on their piece of paper what is their current universe before 2025, which I think is desired so that there's more clarity. 83% of small cap funds choosing Nifty as their tier 2 benchmark without application of mind is something which we are trying to influence in the asset management industry. And Nilesh is here. I'm sure he will, if he concurs, will get this started.
Okay, then let's ask Nilesh something that I've been waiting to ask. We've all been talking about what should investors do in the new year 2025. Nilesh, if I were to ask you 3 things investors should absolutely not do in the year 2025, what would they be?
So 1, please don't trade in futures and options unless until you are very, very disciplined or very, very lucky. 9 out of 10 traders lose money trading in F&O. Think of you competing with Iron Man who is having his specialized suit. On the opposite side of you in trading of F&O is a person with algorithms, with better connectivity and faster calculation. It's unlikely that a normal person will be able to defeat Iron Man, so don't trade. Second, have patience. There will be ups and downs in the market. If you try to jump out of roller coaster in between, you are bound to get injured and you will not enjoy the ride. Close your eyes when you are fearful, but stay seated on the roller coaster. At the end, you will be happy that yes, I took that journey. So don't get out in the middle. Follow your financial path. Finally, have limited realistic expectation. Last 5 years return were exceptional. It's not going to get repeated in the future. So go in with realistic lower expectations.
That's very clear, isn't it, Andrew? Realistic, lower expectations in the year 2025. If I were to ask you that, 3 things that investors should absolutely not do in the new year.
So I think actually Nilesh has summarized, I think, what most of us would be thinking for investors not to do. I suppose one of the things I'd kind of, it's not that it's not for them not to do. What they should do is think about the opportunity cost of being in equities against other asset classes. So something that they shouldn't forget. If our expectations are for a lower equity market, is there some other asset class in the kind of short to medium term which could deliver better returns? So don't forget other asset classes as well, which could deliver higher returns. In terms of kind of speculating in the market and so forth, I agree with you, Nash. It's a very difficult game. If you're going to do it, then really have kind of strict stop loss limits which you adhere to. And finally, I just think looking at kind of fixed income, if you expect interest rates to fall over the next 1 year, is probably not a bad strategy in terms of containing in terms of the volatility of markets which might happen. So you're protecting capital.
Feroz, your cautionary wisdom for the investors watching this broadcast, what are the things that they should absolutely stay away from? What are the 3 things that investors should not do in 2025?
So the first thing I would say is not setting a goal. I see investors not even having a goal. It's like sailing without a compass. It's like taking off without knowing where you're going to land. Most people don't have goals and they keep debating till the cows come home. Which scheme should I buy? Which fund manager is good? What sector is good? What's your goal? What are you saving for? How will you get there? Work backwards, get an Excel sheet. So that's something which is lacking. And even HNIs, ultra HNIs, I've met people with 1,000 crores. They don't have a very clearly defined goal. Log kehte hain, jitna paisa ban jaye, utna acha. Yeah, this is not the way you manage your money. So that's one thing which I'm telling very strongly wherever I could meet an individual to influence them with strong statements to start setting goals which are more pointed, just like a corporate runs its business. That's one prun you can take or a promise you can make to yourself. And the second thing which most people fail to understand is that tax and death are 2 certainties. Most people don't understand the implication of taxation of their actions, right? Nobody knows section 70 to 74, 94.8. All these 4 or 5 important sections are very important. So the point I'm trying to make is understand tax implication of each of your actions in 2025. That's a good personal finance resolution to take out. The third thing will, of course, be veto of Nilesh sir. Don't dabble in derivatives, and I'll give you some pointed reasons why dabbling in derivatives, unless you understand what are option Greeks. Option Greeks and second order option Greeks are not even known to people. What is delta, gamma, theta, vega, rho, or vera and beta are not known. If you don't know these 7, you are a speculator in options market. The second point I'm trying to make is there is one circular which came on 22nd March 2020, which was before the lockdown. There was one circular which limits Indian markets to have unlimited short selling. That's one of the prime reasons why Indian markets have delivered lesser volatility than S&P 500. Nifty has lesser standard deviation than S&P 500 from that date on. So markets are stable is why people have not lost their shirt because of this circular. I personally think the volatility is lower is why people have been able to survive. Don't expect that to happen. Third, like Nilesh sir said, there are enough algorithms where you can use AI and induce volatility in the market. Nifty itself has become a derivative of the derivative market today. And that's why I think you should remain out of it. But one survey I did in 3 of the events which were retail, which I participated in, to understand, we asked them 2 questions. Do you do derivatives? if 100 people said they do derivatives, we asked the same 100 people, how many of you do SIP? You'd be pleased, and the regulator would also be pleased. 72% of the same guys who are doing derivatives are also respecting disciplined investments, which is SIP.
All right, I'm afraid we'll have to leave it at that. We're completely out of time here on the show. Thank you, Andrew Holland, CEO of Ventus Capital, Feroz Aziz, Deputy CEO of Anand Rathi Wealth, and of course, Mr. Nilesh Shah, Managing Director of Kotak Mahindra Asset Management Company. Thank you all three of you gentlemen for taking time out to be with us on this very special broadcast. Thank you so much for watching. This is Krishna Kumar signing off.